Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to look at Nvidia as part of our three-part series. We did Intel, we did AMD, now we're going to do Nvidia. Take a look at this monster growth stock, figure out how much cash money it makes, and what we think we can earn if we buy the stock today and hold it for a decade. Ready? Let's get to work. All right, before we start on Nvidia, I want to remind everyone the 5 key factors that we use to value all stocks here at this channel. Number 1, top line revenue growth. Got to have it. Number 2, earnings growth. Enterprise level earnings need to be growing. Number 3, strong free cash flow. Number 4, low debt. Number 5, well-priced stock. What is a well-priced stock? I want a conservative forecast that's going to beat the market. That's it. Very simple to say, very hard to do. All right, let's dive into Nvidia. Let's take a look at their revenue. So the 9 years of revenue, 2013, $4.1 billion, grew to 4.6, 5, 6.9. It's continued to grow with a little step down in 2019, but it continued to produce a monster all-time high for them, $26.9 billion. Great job, team. Fantastic. That is a 26% annualized growth rate, which has been fairly steady. I take that back. It's more than double the last couple years, but they were even managing to grow it here in the last decade, which I really like. EBITDA followed the same trend, right? Monster growth every single year, absolutely amazing. And then the last year, they just crushed it. The pandemic absolutely crushed earnings for these guys, and they're forecasting further crushing of earnings. Again, enterprise level, I'm not looking at EPS, earnings per share, I'm looking at enterprise level EBITDA earnings. That's a 41% growth rate. You'll notice the growth rate here is faster than here. That means margins are growing. So EBITDA margins getting wider and wider as this growth is outpacing this growth. So let's take a look at how much debt they have. $1.3 billion to $11.6 billion. That's a strong growth rate of 30%, but it's nothing when you look at their earnings. Last year, they made $11.2 billion of earnings. They have $11.6 billion of debt. No problem. 1 year operating, and they can pay that off completely. But what we also want to look at is excess cash outstanding. That's simply cash that's on the balance sheet that's not even in the checking account to run the business. It's so much cash, it's excess. And it sits typically in the short-term investment line on the balance sheet. That's the one I pull. And I thought it was fascinating. You've got $3.5 billion of jack sitting on the short-term investment line of the balance sheet in 2013, and total revenue was $4.1 billion. So they had almost as much cash as they had revenue sitting on the balance sheet. That's amazing. It's a rarity, I would say. And then that number's done nothing but gone north as they've made more and more cash over this time, and they're at $19 billion of cash on the balance sheet, not including what's in their checking account. And what I like about that is that cash can pay off that debt right away. You might even argue why you even have this debt. Some of this is operating lease, which isn't actually debt. It's like your rent payments or you lease equipment and you don't buy it for cash, you just lease it. There are reasons to do that, and there are reasons companies have debt on their balance sheet while they still have lots of cash. But nevertheless, we want to take it into account. Market cap, absolute smoke show. $9 billion has gone to $620 billion in market cap. Whew, that's incredible. If I add the market cap and the debt, less the cash, I get enterprise value. Enterprise value, 7 to 600. That's almost a 90% growth over that period of time. Absolutely amazing. We covered this before. Net debt 0. They have 0 debt. That's checks our box if we want to see. And I want to stop here and give a pause and show you this amazing curve that has happened to the owners of Nvidia over the last decade. Market multiple. You bought a company that had for 10 times EBITDA, which is what semiconductors trade for. They trade in single digits. 8, 7, 10 times, that's fine range. For a company, you bought it at $8 billion, $7, $8 billion enterprise value. It was making $4 billion. So you can see right there, $4 billion a year of revenue, decent earnings, had more cash on the balance sheet. It was a great time to buy the stock right there. And then what happened? They continued to perform. Sales grew, earnings grew, and market multiple expanded tremendously from 10 times roughly to 54 times. That means every single dollar that they made was valued at 10 times back in the day, is now valued at 54 times currently. So what's happened here is you had a dramatic expansion of both earnings and market multiple, which is compounded to give a hockey stick curve to the historical return on Nvidia. And the question is, what happens here? I will also note here that in 2018, the market multiple halved from 45 times to 21 times. And what happened to the stock price right there? $61 to $35. It halved like that in a year. And that's what happens when you get something with a high market multiple. You can have a year where growth doesn't live up to expectations, something happens and it's halved right away and you lose half your investment. So be very careful with buying stocks that are high rated like this. We should not see this continue. And I think over time, this number is going to come back down and that's going to weigh on return. If you bought the stock here, fantastic, great for you. Buying it here is a different decision that we need to make, and we're going to take a look at that. All right, let's take a look at cash flow. That's my favorite statement. It's your favorite statement. Let's take a look at the cash flow statement. So cash flow from operations, the first third of the cash flow statement, right? $800 million of cash flow from operation has grown to $9.1 billion. That's a 35% annualized growth rate. That's in line with EBITDA. So they're expensing the cash that's coming through. I like that. They are doing a good job on the accounting side. Kudos to the team. CAPEX is extremely light for some company that's making $9 billion of jack. Basically 10% of the money they have to reinvest in the business. That is very light, and it means most of this money is going to flow all the way through. Now, they borrowed a little debt here, but that's basically not, it doesn't really matter. They have zero debt. They can totally borrow money if they wish. What I'll do is I'll zero this out so you can see what the cash flow per share looks like without the debt, because it is kind of an anomaly. There it is. $3.02 is the cash flow per share. Yielding 1.3 is the, I'll put this debt back so I have it right. But that's what we're dealing with. We're dealing with a stock that's making $3.50 of free cash flow, yielding 1.3%. Trading at a 45 times enterprise value multiple. So this is a rich stock. Multiple is high, yield low. That is a very rich stock. Let's forecast this business and see what it turns into. All right, so here we go. If I read the quarterly return for Nvidia, they forecast Q1. They're telling us it's going to be very strong quarter. You can annualize that, get a feel for what the full year looks like. That's a 33% move year over year. That puts EBITDA just shy of $15 billion, which is a monster move in this market. Now, I do expect them to continue to grow, and so does the street. But I don't know if it's going to go at 33% every single year. I got to bring it down to some degree to be somewhat conservative for me as my own investor. And I'm going to bring that down over time. Now, what's going to happen is the EBITDA is going to go from $15 billion to $40 billion. That's a monster move, and there's a lot of growth baked into that. I'm also giving a very strong EBITDA market multiple, 18 times. I still think that's a premium to all of the semiconductor manufacturers, and it's substantially lower than where they're trading at currently at 54 times. And I think this number is going to come back down, and that decrease is going to weigh on the stock return, even though earnings is growing. Now go back and take a look at my Microsoft 30-year video, where I look at 30 years of history. In the .com, they were trading it at 100 times enterprise value, and that collapsed and comes down. Even though every single year the earnings grow, the stock price cratered because the stock is both a combination of growth of the stock earnings and the market multiple it trades at. So this is going to come down. That puts it at $700 billion enterprise value, no debt, a little bit of cash. I get $750 billion of enterprise value. Divided by shares, I get $295 per share on the enterprise value method for valuing Nvidia. Now, if I take a look at free cash flow, remember we said about $3.50 if I put aside debt. I grow that at 33%. I get $4.27. That basically balloons up to almost just over $11.50, $11.58, and I put a yield on that. That's a lower yield, it's a higher yield than the 1.8 it's currently trading at. So I'm still giving it kind of a premium, and I get just shy of $290, $289 per share for Nvidia out a decade from now. Now I can look in the stock market today and I can buy all the shares I want at $247 a share. And when I look at our value 10 years out, I think we're going to be in the 290 to 295 range. We're calling it 292. If I put this into an IRR calculator, right, I get the cash flow, which is strong for this business, over that period of time. I buy it here, I sell it here, and what it produces, unfortunately, is a 5% annual return. I think a lot of the money that has been made in the stock are people who bought it a decade ago at 10 times enterprise value and are now owning it at 54 times. That expansion of the market multiple is driving a lion's share of the return. Yes, earnings have grown substantially, but if I were to put this stock back at 9 times, let's see how much this stock would be worth if it's still traded where it used to back then. And what I can do is I can take market cap, I can take enterprise value, and I can multiply it times my enterprise value number. That's $109 billion of enterprise value. And what I can do is I can take this less debt plus cash, that's market cap, divide by the shares outstanding, and I get a price dollar of $48.28. If I were to apply the current market multiple, which at the time they were growing in the future, they were still projecting growth, so that's still a growth stock back then, just not nearly as fast. If I apply the same market multiple, it's a $46 stock. It's currently trading at $240 a share. It's a monster decline. And that decline is going to weigh on the return. And for me, it's not worth the risk. I want the growth. I absolutely do. It's a wonderful company. But I think that the market multiple decline possibility is too much to risk. So let's recap the 5 key factors. Number 1, top line revenue growth. Absolutely, smoke show, it's fantastic. Earnings growth, yes, very, very high. Free cash flow, yeah, check the box. Low debt, it's 0, check the box. Well priced, no, I think it's expensive. I think it was well priced earlier in the decade or 10 years ago. I think now it's very, very overpriced and I would be careful about buying it. If we put this return into a matrix, it's currently at $2.47, it's 5% return. If it goes up, I think it's even less of a buy. I can't get it to be a buy. I'm talking less than sub 180, which I don't know if it's going to happen. So for me, I think there's just too much risk here. I don't know what the future growth curve is going to look like. We already have 35, 30, 25% annualized earnings growth, which is hard to do, out for a decade. Plus then the market multiple needs to be maintained. I think in this market of rising interest rates, the competitive landscape that is the semiconductor business, I'm going to give it a meh. I'm not giving it a bad because I love the company. I think it's a great company, but I can't get over the fact that it's trading at such a high multiple when it could have bought it for a lot cheaper back in the day. I'm going to roll my dice, go with Intel. I think it's a cheaper investment. I'm going to bet 10 years from now, Intel will outperform Nvidia. If you want to learn how to do this, maybe you don't like my growth assumptions, you want to do your own, I can give you this financial model. Check out my website, cashflowinvestingpro.com. I teach a course on how to become a financial analyst, how to learn to do this for yourself. I'll give you the Excel sheet. I'll show you 10Ks. I'll teach you how to value Apple, and you can build a portfolio for yourself, having valued each of the stocks in your portfolio, and you'll be much better positioned for the future. If you don't want to do the valuation yourself, but just want to get valuation feedback, I do one-pagers that on my website, the Cash Flow Club. Same website. Click on the Cash Flow Club in the upper left-hand corner of the link. And I just summarize businesses that I'm reviewing for this show. I do one show a week on YouTube, but I release maybe a dozen or so reviews every single month in the Cash Flow Club. Definitely check that out, cashflowinvestingpro.com. Thank you for watching the review on Nvidia. I really, really appreciate it. Hit the like and subscribe button if you will. Throw a comment down below. Tell me what stock you want to see next. Also, if you want to see other stocks on valuations of various value companies, Up's going to pop a couple new videos. Check those out. I really appreciate the views. Again, hope everyone's safe. Thank you very much for watching the video. Take care and happy investing. Bye-bye.